Good afternoon, everyone. Thank you for joining us for today's session in the Guided by Corner webinar series, where we bring helpful, relevant education directly to the volunteer leaders and stakeholders who serve their communities. My name is Andrew Batshaw, and I'll be your moderator for today's webinar, Accounting for Associations. We're excited to have you with us and hope this session provides meaningful insight into how association accounting works and why it matters. Before I begin, I'd like to tell you a little bit about Corner Property Management. Corner was founded on the principle that property management should be personal, proactive, and professional. We specialize in providing full service management to community associations throughout Pennsylvania and New Jersey with a focus on transparency, responsiveness, and tailored solutions. Our team brings deep industry knowledge and a hands-on approach to help board members make informed decisions and keep their communities thriving. Today's speaker is someone who represents the financial backbone of what we do here at Corner. Andrea Dedrick, CPA, is our Chief Financial Officer. Andrea holds a BS in accounting from Boston University. She brings over 15 years of accounting and financial leadership experience with a focus on community association finances. Prior to her entry into the community association industry, Andrea spent 20 years in public accounting, specializing in audit and taxes for privately held businesses. Andrea's work at Corner ensures that our clients receive accurate, timely, and comprehensive financial reporting with an approach that emphasizes clarity, compliance, and long-term planning. Andrea is a licensed certified public accountant and a member of the American Institute of CPAs and the New Jersey Society of CPAs. Andrea understands the unique needs and challenges of community associations, and she's passionate about helping board members feel confident in their financial oversight role. Before we begin the presentation, just a quick housekeeping note. We'll have a Q&A session at the end, so please feel free to submit your questions anytime using the Q&A feature here in Zoom, which can be found on your control panel. We'll get to as many as we can after the main presentation. We will also be recording this presentation, and we'll be sending it to those attendees to be able to view at their leisure after the webinar. With that, I'm very pleased to turn things over to Andrea Dedrick.
Thank you very much. Welcome, everybody. Very excited about this. So the agenda that we have for today, as Andy said, welcome introductions, accounting for associations. We'll do some Q&A and then the closing remarks. And with that, we will get the presentation started. So we're going to be discussing an introduction of accounting, the balance sheet, the income statement, and the areas of focus for the boards. So why is this important? Accounting tells a story of what is going on in your association. Not every financial looks the same, and you should be looking at your financials every month to see what is going on in your associations. But there's a story to be told about where you are financially, problems that might be coming up, or things that we need to be looking for in the future. The question that I get a lot is the difference between accrual versus cash accounting. And again, some of this I'm going to do high level, and most of the financials that you'll see are pretty basic. Again, everybody's looks a little bit differently, but we want to just go over the broad spectrum of accounting. Accrual versus cash. Accrual means the revenue is recorded when earned, whether or not it is collected. So every month we bill the maintenance fees or the assessments, and you'll see that on your top line of your income. Even though that money is not collected, it still shows as revenue because we have earned it. And on the flip side, the expenses are recorded when incurred, not when it is paid. So again, it is landscaper comes on site, does a service today, July 17th. We get a bill that should be recorded in July, even if the bill is not paid until maybe August or September for whatever reason. Maybe my landscaper was a bad example. Again, it depends on if we're getting the invoices on a timely basis, but we want to try and get all of the expenses based on when they were incurred and get those into the monthly financials. It's not a perfect system, again, because we are dependent on some vendors to get us that information in those invoices, but that is the goal of accrual. The cash accounting is very simple. Cash comes in, that's when it gets recorded. Cash goes out, that's when that expense is recorded. I think the accrual basis of accounting shows a much broader picture as to what is going on in the association. We want to see, what are your receivables? What do the homeowners owe the association? And again, what does the association owe other vendors on the accounts payable? If you were doing a straight cash accounting, you would show income, I'm going to use round numbers, $10,000 worth of income, and then $5,000 of expenses. Your net income would be $5,000 under cash. But if there was an invoice that was out there that should be accrued or included in your payables for maybe $20,000, you could see how that would skew what the financials look like. So that's why, for the most part, we do accrual basis accounting, because it shows a broader picture as to what is going on in the association. So let's start with the balance sheet. That's the first page of your financial. And this is shown to show just the top assets. And again, like I said, some of you will have some other items, but again, this is the most general balance sheet. And you have your cash. For the majority of people, there's operating cash, there's reserve cash. You might also have deferred, working capital, a number of other different types of cash accounts that we are tracking, along with some investments. Again, this one is a pretty simple one. We have maintenance fee receivable. This is what your homeowners owe the association. We have prepaid insurance and allowance for doubtful accounts. So we're going to break this down a little bit. Your cash. The cash is what you have at any point in time. And I get this question a lot. It doesn't equal my bank statement. And you might be correct. If on the last day of July, I write a check for $5,000, the financials will record a reduction of cash for that $5,000. However, if it hasn't cleared your bank, the bank balance would show a balance of $5,000 higher. What is on the balance sheet is what is actually cash available. We have written that check. That check is now deducted from the cash balance on your balance sheet. Investments, you might have cash, money markets, and CDs. Again, this was a basic financial. The accounts receivable, what the homeowners owe the association, and that is from any point in time until today. So if you have a homeowner who hasn't paid their dues since day one and that balance is growing, that full balance will be on the balance sheet. It will also include legal fees, late fees, any sort of other items that have been charged to the homeowners association. So it would be, it will be the full amount that is owed to the association. The allowance for doubtful accounts, let me go back to my balance sheet. It's a reserve against the receivables. And the best way to explain this is, if my, and I hope none of you know my dopey brother, but if my dopey brother owes me $10,000, my allowance should probably be about $10,000. Because he's really not going to pay me. So that's what the allowance for doubtful accounts is. It is a reserve against the receivables. And we do some work on that during the budget season, and we will book some of the bad debt on the expense, on the P&L, and on the balance sheet. But then usually the auditor comes in, does a full assessment of the receivables, and they make an assessment as to how much they think will actually be collected. I also got a lot of questions about the prepaid insurance. The prepaid insurance, the way insurance works a lot of times is there's a large down payment due at the beginning of the policy. And what we do is we book that to prepaid insurance, and then we amortize that based on 1/12 each month. So you'll see this prepaid insurance amount, because if you did cancel the insurance policy, there would be some money for the association because we have prepaid some of that. So that is a basic asset section of the balance sheet. The other side of the balance sheet is your liabilities and reserves, your funds and your equity. Accounts payable. What do you owe vendors at any point in time? And again, the balance sheet is a snapshot in time. It is on the last day of the month. This is what it shows. And the next day it will change. But on the last day of the month, what do you owe your vendors? And again, that's what we show here. Prepaid maintenance fees. If on July 31st, I pay my maintenance fees for August, what our system does is properly records it as a prepaid maintenance fee, and then it will be flipped to revenue come August 1st, because on August 1st, and that's when that amount of money has been earned. So if I pay my August assessment early, technically, if the world were to end, the association would owe me that money back. That's why it's shown as a liability. But again, when it is earned at the first of the month, the next month, it will flip to revenue. We have your reserve fund here. Let me go to my notes. Your reserve fund is what is there, not what should be there. So if you go to do your reserve study, it may say you should have a certain amount in your reserves. This reserve fund is just a collection of what has happened in the reserve fund since the beginning of time. We've had contributions, we've had interest income, maybe we've had expenses, and this becomes just a rolling forward of what is going on in the reserve fund. And again, it doesn't mean that that's what should be in the reserve, because again, the engineer might come back and say, oh, you should have 500,000, and this association only has 63,000. That's where we would have a problem in the financials there. The retained earnings. Retained earnings is the profit and losses from the beginning of the association. So anytime maybe you had a really good, we didn't have any snow one year and your association showed income, that gets rolled into the retained earnings at the end of the year. We have a bad snow season and you show a loss. That loss would get rolled into the retained earnings. So it is a accumulation of all the profits and losses through the prior past year end. And what's happening in the current year end is the net income and loss. I'll go back to my balance sheet. Just this is the net income for the period for this fiscal year. So that would be your liabilities, your funds, and your retained earnings and net income, also known as your equity. And that is your balance sheet. Now we go to the next page on your financials would be your income statement or statement of revenues and expenses. And it comes in 3 sections. The first couple columns is the current month. The second group of columns is the year to date. And the third is the budget. So you can see this is your current period, this is your year to date, and this is your annual budget. Sometimes it's hard to look at these at just the current month because again, one month might not dictate what is truly going on over a time period in your association. So when you look at the income statement or statement of revenues and expenses, we have maintenance fees, and they should really not be much of a variance. If we budgeted properly, again, it is on an accrual basis. So if we record everything that we should be billing, there really should not be much of a variance in here. Sometimes we have it because there's some rounding. Some of you might have percentage ownership, and that doesn't come out always to the exact penny. But so we also have your interest income and the reserves. You'll see later on, you'll have interest income in the reserves. Down below, there'll be a corresponding expense item so that we can put that onto the balance sheet and put that into the fund. And also you'll see legal reimbursements, and that usually has an offset to an expense as well. And those are the fees that get charged to the homeowners, are people who are not paying. So that's just a basic side of the income of the profit and loss statement. Then we get to the expenses. Again, management fees should not have a variance if it's budgeted and billed correctly. And you want to look at your variances. For most of the items, the budget is split monthly, 1/12 each month. Your office expenses, if it's $1,200 for the year, you'll see we do the budget at $100 a month. We don't break that down further just because, again, it's very hard to determine, are we going to do, this postage this month or a mailing this month? We just do a general 1/12 across the year, except for a few items. Seasonal items like snow will be spread out between January, February, March, November, and December, or sometimes just December, or landscaping. Most of your landscaping, irrigation, pool should really be only budgeted during the months where those items will occur. Unless you have a specific contract that shows the different payments. Other than that, we'll just split it across those months in which the pool is going to be open. Your reserve funding, this too should have no variance. It is either we reserve, we move the money into the reserve fund, or we're creating a payable. So if your association is a little tight on cash and can't move the money this month, maybe you just made your insurance payment, down payment, or a big landscaping bill or something, we still create the payable so that we're keeping track of what money is owed. Again, that's very important that we're trying to show the full amount of expenses that are happening in the association every single month. So that would be your basic profit and loss statement. So some of the things that we want the boards to focus on: your cash. Do you have enough cash to manage your payables every month? Are you guys running a little short? Sometimes it is a timing thing. Again, as I said, summer is always a tough time if you've got the pool, the landscaping, irrigation, and maybe the down payment of an insurance bill happening all at once. That can be managed. But again, you want to make sure that there's enough cash to meet your daily, day in, day out expenditures. Your accounts receivable. Look at the accounts receivable balance. Are you seeing somebody on there that shouldn't be on there? Somebody who is paid, if I've always paid every single month on time and I all of a sudden show up on the receivables, maybe there's a problem. So you want to look at that. You also want to look again at your AP. Are you being able to meet your day-to-day expenses? And did things happen as though how you thought they were? Did you buy a CD and you're not seeing that on the balance sheet? Did you borrow money? If there's anything that's happening in the association, it gets reflected in the financials. And that's why I said the financials tell a story. If something is going on in the association, the financials should reflect that. So you want to make sure that anything that is happening is shown up there. Maybe there's a large insurance claim and we just got the insurance check. Is that being reflected there? And again, some of this could be timing. On your income statement, you want to look at your variances. And like I said, it might be easier to look at your year-to-date variances because it's a few more months under the belt of the association and tells a little bit of a story. Variances are okay to have. I do get some people that say, well, if I put it in this line item, it's going to go over budget, so I'm going to put it somewhere else. Don't do that. We want the expenses to be true expenses in the category that they belong, because if we have under budgeted, we need to be aware of that for next year's budget. Or if something is going on, we budgeted $500 for exterminator, and we had a horrible season of um, the wasps or something like that. We want to make sure that we are truly tracking those type of expenses and they can be explained. So even if we do go over budget, it is okay if we can explain. Maybe we had a sinkhole, we had a water main break, whatever it is, whatever is going on in the association, we want to make sure that that is being reflected. And if it shows up as a variance, that is okay. We just need to understand why. And again, on your income statement, did things happen as you thought they would? Again, we had a tree that came down with some of these crazy storms that we are having. Probably not in July, but in August, we might get a bill from the tree company. And that might not have been budgeted because we were not expecting that. That would produce a variance in our maybe landscaping enhancements or landscaping other type of expenses. But again, that tells a story. And when we look to go do the budget, we look at those variances and say, is that a one-time event? Or is this something that we now need to build into the budget going forward? So again, we always are looking at these type of items and looking at those variances. So just in summary, and again, this was a basic financial, just to give you an overview of what's in there, is very important that you're really looking at your financials, you're hopefully understanding what those financials are. And every association is assigned an accountant. So if there's any questions that you have, you do have someone that you can go to directly for your day-to-day questions on the financials. And again, a strong accounting team is essential to the smooth financial operations of any associations. It's important that you have this dedicated accountant who understands your budget, reporting needs, and financial goals. They are your partner, and that's how I view the accounting department. We are your partner in the process of running the organization. So that's why we are very passionate about having these financials done timely, accurately, because again, you need this information to run the business of the association. And so if you do have any questions, put them in the Q&A section of the chat, and then we can open it up for questions.
Thanks so much, Andrea. That was great. First question we have for you.
Yes.
What are some of the, in your experience, what are some of the most common financial pitfalls that associations face, and how can better accounting practices help avoid them?
So one of the things I would say, the pitfalls that I see a lot of the associations run into starts with the budget. So if your budget is not a real budget, you will run into financial problems. So what I like to tell people is we want to build the budget from the bottom up, meaning I want every single one of your expenses listed out. And then what has to pop out is the revenue. So I've gone to many budget meetings where I've built this beautiful budget, and unfortunately the association needs to raise the dues $20, $30 a month, and I go to sit down and they go, we're only raising the dues $5 a month. We haven't accurately built a budget that will be able to maintain and pay their day-to-day bills. And in doing so, and I understand as a board member, you're like, I want to be able to go to the pool and go to my mailbox without being accosted by people going, you raised the dues $10. But what people have to understand is every expense item increases. And what we are seeing with a lot of the associations, the insurance and the reserve study are having a big financial impact on our associations. So it really is important that we're really honest about how we're setting up the budget, because if that's not done well, we're going to have a financial crunch throughout the time. And also what's going to happen is if you're not putting enough money away every single month, every single year, when it comes time to do a project like a roof or something like that, your reserves are going to be short. And at that point, the association might have to take out a loan in order to pay for some of these projects.
Thanks, Andrea. Another question. What are accrued expenses? And you please provide an example.
Sure. One of the accrued expenses that we do at the end of the year is the audit fee. We want the audit fee, so the 2025 audit fee will be accrued because we're not going to get that invoice until 2026, but it pertains to the 2025 financials. So we will accrue that expense, and that's usually one that we will always accrue. Or what you'll see, and one of my most dreaded things is we get a huge snowstorm on December 28th. So what happens is everybody comes out, they do the snow plowing. We don't get those bills from the landscaper or the snow company until pretty late. So we want to make sure that we are accruing it so that, again, it occurred in December. We want to make sure that that expenditure is in December. What I don't like to do is, if we don't have a utility bill 1 month, I don't like to accrue and reverse and accrue and reverse, only because that creates a lot of noise in the general ledger. So usually we'll accrue something if we really don't, either we know specifically we're going to have this expenditure. If it is material to the financial statements, meaning I'm not going to accrue a $5 postage item, but if we have a huge tree that came down and it's $30,000 to remove the tree, I will accrue that just so we get the right expenditures in the right year.
Fantastic. Thank you, Andrea. We have a question that may not be an accounting question. It might be a little bit more of a governance question, but
I will
feel
do
free to
my
jump in
best.
if you'd like, Andrea.
Okay,
And I'm gonna give a shot at the answer first, and then you can jump in.
perfect.
So, what do we do if we want to add an amenity that we can pay for from our operating account since we were under budget in several line items? So, for me as an operator, not on the accounting side, the answer would be you really have to refer to your governing documents about what your association is allowed to do with a budget surplus. More than often, it says that that budget surplus either has to move to reserves or has to be returned. There also might be local state law that will supersede that. And if you're adding an amenity, your documents may require that there be a community vote on the addition of that amenity. So our best recommendation there would be to refer to your governing documents and possibly also speak with association counsel on how best to address that. Andrea, anything you want to add there?
I would add, depending on what it is you are adding, it might then have to be included, excuse me, into your reserve study going forward. And then also, what is the maintenance of whatever it is you're adding? Because then that needs to be added to your budget. As far as the surpluses, we can always, again, there's always going to be a little bit of ups and downs. We just want to make sure that you have enough. If you have 1 year that you don't have snow, again, the next year might be a horrible snowstorm. So we don't want to just immediately give back a surplus. We can work it into the next year's budget as well. But again, as Andy said, all these things you need to consider before you go and build a tennis court, a pickleball court, or something like that. Again, you have to look at your documents and then also understand the financial impact going forward and how are you going to maintain this going forward.
Thank you, Andrea. Another question. How do we properly budget if we have a loan?
So that's an excellent question. So a little tricky in the financial thing, but what we need to do in our budget, we are going to have a line item for debt service or principal and interest. So if we have to, whatever the debt service is, goes into the budget line item. However, throughout the year, when we record the interest and principal, the principal goes to the balance sheet, and it will create a little bit of an income just because of accounting rules, but you need to have the full amount, the principal and interest in the budget in order to generate enough cash so that you are paying for being able to make all the debt service requirements. So that's when there's someone who has a loan, an association, that's something that we look at very carefully when we are doing the budget. But the full amount of the debt service needs to be in the budget line item.
Great. Thank you, Andrea. Another question for you. As a board member where numbers just really aren't my thing, what is the most important thing in the financial statement or the most important sections of the financial statement that I should be looking at that I can really understand?
Okay. That's an excellent question. And again, for anybody, this is the perfect webinar for anybody who is just not accounting savvy. And that is okay. Everybody has their own specialties and expertise. But the things that I would focus are the cash and the payables. Again, think about your own household checkbook. Do I have enough money to pay my bills? And that's probably the most important thing that I would focus on as a board member. And then also looking at the receivables. Are they growing? And is there anything we can do to catch people early enough, get them on a payment plan, or do something so that those receivables don't continue to grow? And then also I would look at your variances, the year-to-date variances. Is there a reason why something is going over budget if it is significantly over budget? Also, you can also reach out to your accountant, and we are always happy to explain anything in the financials to you. I do these type of webinars and seminars for boards all the time. So I'm always happy to explain the accounting to anybody.
Thank you. Another question here for you. As a
Yes.
new board member, I see in my financial statement, prepaid maintenance fees are a liability. Why
Yes.
is that?
So again, if somebody pays, so if I write a check on July 31st for my August maintenance, it hasn't been earned in the accrual basis of accounting. So it shows on the balance sheet as a liability. And again, if the world ended on July 31st, those people would be owed money back because August never happened. So the majority of the prepaid shows up as a liability until it is earned in the next month. And what you'll also see in our financials, you do get a listing of everybody that is prepaid. What we do find is some people go, oh, I'm going to go to Florida for the winter, so I'm going to prepay 4 months in advance. And then what happens is they get this large prepaid balance, and every month that when the assessment is billed, it eats away at that prepaid balance. So the prepaid balance is not a bad thing. Again, the association is getting the cash in advance. But again, sometimes we can't control how our homeowners want to run their own finances in their world. We have some homeowners that don't want to be bothered with monthly payments, so they pay once they get the notice of what it's going to be for the year or each month. They pay that all in advance. So again, if they were to sell their home, they would get that money back because again, the timing of when that revenue is earned, and that's what eats away at that credit balance.
Great. Thanks, Andrea. Another question here. Do you recommend making regular reserve payments each month in spite of financial strain on the operating account?
That's an excellent question. And it is, we want to make sure as the accounting team that you are never too short on cash. So if it is, if I have a choice of paying the landscaper or the snow vendor or paying ourselves, we have to pay the vendors first and then the association last. So again, sometimes it might be that just this month, if we have the pool, irrigation, landscaping, and our insurance due, there's not enough cash right now. But as the assessments come in, we'll be generating more money. And maybe in 2 or 3 months, there'll be enough money to pay those the reserve payments. So that's why we create the payable. So we don't lose sight of it. We want to make sure we are remembering we owe ourselves that money. And so we will, the accounting team will normally choose to pay the vendors before we pay ourselves.
Got it. Thank you, Andrea. And we've got one last question here. What should I do if I see in the financials that there's an expense in the wrong line item?
Then what you need to do is just reach out to your accountant, and we can always do a reclass. So when we are doing the AP and where we get a bill in, AP is looking at it, the manager is looking at it, and they're making an estimate as to what line item they think it should be. And some of them are very black and white, but then there's some of them that are a little, I'm not sure, you know. So we do try to do our best guess at where it should be. As you, as the board or the finance committee, want that shown somewhere else, we can easily reclass that. And then it'll be in the right line item for the next month. We don't normally, if we're just doing a reclass, we're not going to reissue the financials, but we'll certainly make that change. And then in the following month, it'll be in the right line item. But definitely let your accountant know, because if this is also an excellent thing. So if we start getting some odd types of bills, but we keep getting them, we need to be very aware of it, because maybe that's something we need to build into the budget for next year. Maybe at the beginning of the year, we really weren't planning on something. And then all of a sudden, as the year went on, something was happening in the association that we really need to think about going forward and start accounting for that, and maybe either put it in a certain line item or create its own GL and its own line item for that.
Great. Thanks, Andrea. We actually have one more question that came in, so I'm going to throw it at you.
Okay.
What is the allowance for doubtful accounts and how is it calculated?
Okay, so the allowance for doubtful accounts in the budget, let's start there. When we do the budget, there should be, if you have an issue with some of your homeowners not paying, we should be building in a bad debt. Think about like your paycheck. As my child came home to me the other day and said, I make, let's say, $60,000 a year, but then all these taxes got taken out, and they really weren't expecting that. They thought they were going to have $60,000 to spend. Doing a bad debt on your budget creates that same type of thing, because not everybody is going to pay the assessment. So we need to account for the fact that we're not going to get all of our revenue when we should. So that, for cash flow, we need to make sure that that happens. Then what the auditors will do is, at the end of the year, looking at the audit, they're going to do an assessment of the receivables. And they'll it's going to be a judgment call as to what the allowance should be and where in the collection process. Like, for instance, if there's been a homeowner that is with the attorney, they have already done liens and judgments and all of this, and they're still not getting any money, that will be in the allowance, because you just want to make sure your balance sheet is reflecting the true amount of the accounts receivable, net of whatever you think you're really not going to collect. So the net of the accounts receivable and the allowance should net out into what are we really expecting to have money come in and pay off those receivables.
Thank you so much, Andrea.
These were really good questions.
Thank you. Thank you all for joining us today for Accounting for Associations, part of our Guided by Corner webinar series. We hope this session gave you greater clarity on the financial responsibilities of community associations and the importance of strong association accounting practices. A big thank you to Andrea for sharing her knowledge and providing such practical, insightful guidance. It's clear that having experienced financial leadership, especially someone with Andrea's background, can make a real difference in how communities understand and manage their finances. If we didn't get to your question during the Q&A, we encourage you to follow up with us directly. We want to make sure that every board member feels equipped to make sound, confident financial decisions. At Corner Property Management, we believe that education and transparency are key to successful community leadership, and that's exactly why we created this series. Please be sure to keep an eye out for future Guided by Corner webinars. We'll continue bringing you content that's relevant, timely, and focused on the real-world issues association boards face every day. If there's a topic that you would like us to cover in a webinar, please send me an email or give me a call. My contact, as well as my counterpart Larry's contact, is displayed on the screen. Thank you again. We hope you all enjoy the rest of your day and have a safe and fantastic weekend, and enjoy the rest of your summer. Take care, everybody.